Well, we've seen the Dow hit a new high overnight. It smashed through the 21,000 mark and it's now within striking distance of 22,000. Investors seemingly ready to look past the chaos in the White House and the looming debt ceiling debate in the United States. Well, for more on where investors can find value, particularly globally, I'm joined by Geoff Wood from Morphic Asset Management, who's in our Sydney CBD studio. Geoff, thanks very much for joining us.
Hi, Helen.
Now, you launched at Morphic a global fund 5 years ago. Of all global markets, has the US stock market in that 5-year period been really the outstanding performer?
It has, yeah. I mean, it's compounded probably at around about 15% a year, including dividends for the last 5 years. So it's been the strongest part of our portfolio.
Yeah, so I mean, it's sort of at the moment it's defying gravity a bit, isn't it? But in a sense, I mean, how heavily have you been invested in the US market?
We've probably ranged from around about 40% of our portfolio to in the range of sort of 60 to 70 at the peak. We're probably at the lower end, or we are at the lower end of that now. I mean, we're starting to look more offshore, as you say. I mean, the US looks relatively expensive in a global context.
All right, but I guess that means you've made a lot of dough in the US over that 5 years.
Correct, yeah.
All right. Now, I mean, if we also look, the time that we've been talking to you and your colleagues, I mean, there are so many concerns that come up all the time. There are worries, and that really spooks the market. And obviously we had the GFC, which was perhaps the mother of all worries.
Yeah.
But from what you can see, looking at risk and all that sort of thing, do equity markets not look rationally enough at risk and concerns?
Well, I think the key phrase is that equity markets climb a wall of worry.
And what does that actually mean?
It means essentially when there's nothing left to worry about, you're probably at the top. I mean, what markets tend to do is they'll worry about a certain event, and when that passes, investors use that as a catalyst to buy in, and that's typically when you see the next new high made. So when we look back over the last 5 years, I mean, there've been some huge worries, and probably the most important one has been the fears around about the implosion of the Eurozone. Now, we were lucky when we launched. It was just a few days after Draghi made that famous speech in London where he said he'll do whatever it would take. And that's just seen a huge de-risking around Europe. There'd been a huge exodus of bond investors out of sovereign debt at the time. And over the last 5 years, that's kind of ground in, and investors just keep coming back to Europe and buying those spreads, which are pretty attractive on a global basis. So that's been one of a classic example of climbing a wall of worry, and as investors have eased around it, they've just put more capital to work.
Yeah, so I mean, can you argue that Draghi and other central bankers have in a sense saved investors?
Yeah, I mean, they've certainly been a huge part of the solution and assistance in both solving the banking crisis and the sovereign debt crisis.
Well, so I suppose printing money always helps, doesn't it?
That's exactly right, yeah. I mean, when there's no one else there to buy it, I mean, that's their job as the buyer of last resort.
Yeah, okay. So what about in terms of what we're talking about, this sort of climbing this wall of worry around the GFC and the recession that did follow in many of the markets after that? Yeah,
so I mean, in that light, another great example has been when we launched 5 years ago, unemployment was around about 8%, and we were still in the depths of the Great Recession, as it was called, and that's ground its way today to be around about 4.5%. So that's been another worry that we've had to get over, and as the money printing that you highlight was a fear in itself. People thought that it would lead to hyperinflation. I mean, gold was trading around about $2,000 when we launched, and that's just suffered as essentially that hyperinflation risk has been priced out of markets, and gold now trades around about sort of 1,200, 1,300. So that's been another risk that the equity markets overcome.
Okay, there were some concerns in Australia, well, not concerns, but there were hopes and expectations in Australia that we would have, that interest rates, meaning the economy might have been strong enough to have interest rates back up at that famous neutral level that was discussed in the last few weeks. That hasn't happened. Just take us forward. Where do you think a couple of these key indicators in Australia are heading? What are you expecting either for the rest of this year and for next year in terms of interest rates, dollar, that sort of thing?
Well, look, if I worked at the RBA, what I'd be doing right now is looking at Canada. Canada did their first hike last month, They're in a very similar situation to Australia. They've got a highly leveraged consumer. They've got a property market that's done phenomenally well. There's a lot of debt on the consumer. They're ultimately a commodity-driven market. And so if I was at the RBA, I'd sit back, I'd watch Canada. They're expected to hike again this half. I would see what happens there, how it impacts the consumer. And given things are going pretty well here, I mean, a lot of the fears haven't materialised in Australia, I'd be looking to hike, 1 or 2 times next year if I was at the RBA, assuming the Canada experiment goes well.
All right, but sorry, is that assuming that inflation has to get higher than where it is now? Because they're indicating they are not going to move until inflation does get a bit higher.
Yeah, well, what we see with these central bankers is once they get an idea in their head that they want to go, they pretty much rationalise it, and what they'll say is that inflation is trending towards the target,
right,
the sort of 2 to 3% band. I mean, we've got some...
So, sorry, are you saying there will be a rate hike early next year?
That's my base case, yeah.
All right.
Yeah.
Just if we look briefly at the United States, because we're going to run out of time, the debt ceiling debate is going to come up. Is that going to play like the other debt ceiling debates that we've had in the past few years also played out?
Yeah, that's the base case we have. I mean, there'll probably be a bit more theatre this time because we've got Donald Trump involved, but normally what happens is the US government gets close to running out of money to pay for its necessary expenditures, and they leave it as late as possible as a tussle. Markets panic and sell off, and then it gets resolved and the world moves on. So that's our base case at the moment, and to exploit that we're buying volatility futures around October, which is roughly when the money should be sort of running out and the government starts getting ready to turn off the light.
Is there one key lesson that you've learned about risk and how to manage risk in investing in equities?
Yeah, I'd say the big lesson is you got to know what regime you're in. Are you in a bull market, a bear market, or a range? And that really should dictate how you're investing.
All right.
I mean, it's a very nuanced view, but I think it's very important in terms of when you choose to allocate capital and take profit.
Yeah, and at what point you get out and in.
Exactly.
All right,
yeah.
Geoff Wood from Morphic Asset Management, great to talk to you. We'll speak again.
Thanks, Anna.